Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Investors were extremely unhappy with the amount of spending going on at Disney Plus and its streaming services. And that's one of the reasons that Bob Chapek is out as CEO and Bob Iger is coming back in. But this business may not be in as bad a shape as it seems, and a $4 billion operating loss last fiscal year may evaporate just by some changes that have been made in the last few months. So let's get into what those are. Before we get there, I do want to remind you to subscribe to Rive Investing. Give this video a like, and of course, give comments that you have on this topic or anything else you're interested in the investing world below. Now, one of the things I think that's interesting with Disney right now is that the biggest criticism is the company's $4 billion loss on the operating line for its streaming business and its content business. This has always been a business that Disney said it would be effectively a loss leader, trying to charge a low price to attract a lot of customers, and then they could ratchet up prices over time. But investors were shocked by simply the scale of the number, especially as we're more focused on earnings right now and not just revenue growth. But there are a couple of changes that have already taken place at Disney that I think are going to be much more impactful than we may be thinking. One is the price increase that has already gone into effect for Disney Plus. Disney Plus was previously $8 a month. Now it is $11 a month. That increase in price, excluding Disney Plus Hotstar, which is their India subsidiary, it's a little bit lower price tier over there. But a little bit over 100 million customers that they have paying that $8 a month, going to $11 a month. That's about $3.7 billion in added revenue. That'll be almost entirely margin. That erases almost that entire operating loss. The other thing that just happens to be happening as Iger walks back in the door is 3-year prepaid subscriptions that you may remember way back from 2019. There were as little as $4 or $5 a month, depending on what your relationship was with Disney at that time. If you had one of their services, you could get a subscription, prepay it for about $4 a month. That is now expiring. So those customers are now not going to be paying $4 a month. They're going to be paying $11 per month. So almost triple in price. I think just those two changes alone could make Disney Plus and the streaming services that they have a positive operating income business in 2023. I don't think it's any coincidence that Bob Iger is walking in the door just as these two things hit. He knows that those revenue increases are coming. He knows he doesn't have to do any work to have that tailwind behind him. And they can still have some cost cuts on the production side, which I think were already kind of in the works, as a lot of these companies are rationalizing what they're doing from production and content spending. So Disney's net income over the last year was just over $3 billion. Their stock is trading at 50 times earnings. But think about just this price increase that I've talked about here alone could almost double that net income number. I think there's a lot of financial potential with Disney very quickly with some very small changes. This may not look like a value stock today, but given the tailwinds that the streaming business has, the flexibility Disney has to increase prices and add that ad-supported tier, I think this is a much better positioned company and a much better positioned streaming service than it seems on the surface. What do you think? Leave your comments in the comments section below. Give this video a like and subscribe to Rive Investing. I really appreciate it, and I'll see you here next time.